What's up, everyone? Welcome back to the Outlier podcast. Familiar face, Tom Sosnoff, coming back to tell us all about the Fed rate cut, the abatement of vol, and how it's all smooth sailing from here. And is that right? I got that all down?
Perfect. Yes. Smooth sailing.
Perfect. Well, just wrap it up from here.
Yeah.
So I know that you're not necessarily overly into like the Fed as like the dominant factor, more the bond side controlling things. Looking forward right now, bonds look like they're pricing in maybe another 25 bips to 50 bips over the next month, and then, potentially a subsequent cut the following month. What do you think of that campaign in general, and specifically what kind of impact that can have on the market near term, since we just went, like 5 meetings since the last cut, something like that? No.
Well, I mean, since the cut, 2 weeks ago, bonds have gone straight down. So they've gone the exact opposite direction. They dropped a little over 2 points. I mean, I've been buying bonds here the last couple of days, bonds and notes, because I thought they got a little too cheap. I think the market's got bonds and notes priced perfectly. I think they're a little too cheap because everybody tried to get ahead of the rate cut and they choked on it a little bit. I think now, they're priced perfectly. I think you might have one more cut here, not two, this year. I mean, there's probably more coming. I think the CME, indicators are usually spot on, and right now there's about a 90% chance of another cut, and then after that, we'll see.
And if that happens, what's the bleed through effect? The thing that I'm most interested here, to tip my hand, I think what we went through was pretty new, pretty fresh, hadn't seen that kind of Fed policy intervention before. And now we're on the unwind side of it. And there's not really a great reference, especially for people like me. So I lean on people like you that have the intuition.
I always, I actually think the purpose of the Fed, I'm a little different with the Fed than everybody else. First of all, I think the purpose of the Fed is to be there. Their role is to provide catastrophic insurance against, some 2008, 2009, some fiscal cliff, some pandemic, whatever it is. Their job is to provide catastrophic insurance. Other than that, they are going to do exactly what the bond market allows them to do. So the bond market prices these rate cuts way before they get to them. So there's nothing they really have to do except stay in line with the last time they had a surprise rate cut was probably 1998, when they had that like half point, cut. I don't think that there's a surprise rate cut under, in the current makeup of the Fed. And so I think their job, again, is to provide catastrophic insurance if something goes wrong. And if not, they just stick to whatever the bonds or the notes say to them. I mean, the problem with the Fed and what makes the Fed interesting now is that, Trump has been trying to politicize the Fed. And that is the scariest part of, like the Fed itself, Powell's a strong Fed chair, and, they're clear of the concept. It should be an independent, organization. And I think that, Trump, trying to meddle with it, and B, trying to put, this last Fed governor that he put in there, which is clearly just, his own lackey. That's troubling. That's very troubling, because, the Fed needs to be objective. The Fed can't be politicized, and the Fed can't be run by the executive branch. And that is the scary piece.
You mentioned that bonds essentially dictate more or less what the Fed is likely to do, and then it's more on the Fed to stay in line with that.
Yeah, sure.
The last couple times we spoke, you had mentioned that the bonds were pricing in a cut that we didn't get. So how did those reconcile?
The last couple times we talked, actually, the bonds went the other way. They were pricing, if anything, they were, I think, maybe a little miscommunication, because the bonds were pricing in no cut. The bonds have been way too cheap all year for a rate cut. And just recently, they bounced back up to 118. I mean, they've been trading in the 112, 113, 115 handle all year, which is too cheap for a rate cut. And so I thought the bonds were needed to go up in order to get a rate cut. And that's exactly what happened. I've been actually long bonds all year only because I thought they were too cheap and I thought we are going to get rate cuts. But the reason that I just thought we're going to get rate cuts is just because, we've been, because there has been a demand for a rate cut, and B, at this point it was already priced in. There was some level of it trying to get priced in, just couldn't get there fast enough. So nothing the bonds have done in 2025 have surprised me. It's the market that I think has been the shocker. I don't think the bonds have been. I think the dollar's been a surprise. I think gold's been a surprise. I think stocks have been a surprise. I don't think the bonds have. I think the bonds have been the most boring instrument of the year. I think the whole surprise in the bond market is just the politicizing of the Fed. I just think that's the most dangerous thing on the horizon.
So, and thank you for the clarification. It makes a lot of sense. You talk about a bunch of these different asset classes and bonds fixed being mostly in line with expectations. Talk to me a little bit more then about those other relationships that have surprised you, because you listed a few of them. The thing I'm most interested in is not stuff that just moved that was surprising, but more anything that has surprised you with respect to relationships between things.
Well, I don't know, Eric, that there is relationship. I don't know that if they're traditional relationships, bonds and stocks used to have an inverse relationship. That clearly has not been the case for a long time. Now, stocks and volatility have always had an inverse relationship, and that has to remain. That's just, there's nothing that can happen there. But gold and stocks, virtually zero correlation. The dollar and stocks, virtually zero correlation. You can basically pick a commodity now, and there's almost no correlation to stocks. Any one of the various indices, there's almost no tradable correlation. So this has been a strange market in the sense that you can't play one thing against another. I mean, most of the ratios, most of the pairs ratios that we've always traded, man, they're a little out of whack. So I'm not so sure that there's a lot of correlations in there that are out of whack, because I don't even know what a decent correlation is anymore.
Super interesting. Now, obviously, when we're referring to these correlations, super time dependent, right? Like the observation window. So what window are you referencing?
I mean, most correlations are what we would consider short-term swing trades. Okay. So it could be anything from a week or 2 weeks to, a month or 2 months. The whole deal with correlations and they call them intermarket spreads or basis arbitrage. Those are the technical terms for it. Basis arbitrage is just when you trade the spread rather than trade the underlyings. So if you do, for example, S&Ps versus NASDAQ, that's a basis arb. You're trading the basis. You're trading the spread is called the basis, and you're trading the difference between the two indices. You're not trading either indice by itself. And so that spread, all you have to do is do it. It's volatility adjusted notional. You're trading that particular spread, but there's not a lot of rhyme or reason to it, except it has been a mean reverting kind of, a mean reverting trade more than anything else. And that's about all I can say about it. The reason people trade those spreads is, one, because they believe there's a price divergence, and two, because professionals get, and even customers get an 85% reduction in risk. Professionals get a reduction in capital, but retail investors get a reduction in risk of about 85%. So, for example, if you sell NASDAQ and buy S&Ps, you take about 85% of the risk off the table. You still have 15% basis risk, but you take about 85% of the risk off the table. If you do gold versus silver, you take about 85% of the risk off the table in gold and silver, but you still have risk because that spread moves.
In those scenarios, how are you arriving at 85%?
It's actually a number direct from the CME site.
Okay.
So what happens is the CME, the Chicago Mercantile Exchange, on their website essentially lists every intermarket spread, pretty much every single one that's ever traded. Some don't trade at all, but everyone that trades. So they probably have 200 or 300. And what they do is they create basically a span margin index for that particular spread with some ratio so that they can give margin relief. It's called cross margin relief to professionals, to prop traders, to hedge funds, whatever it is. And customers have to put up the money on both sides, but they still get the risk reduction. So the CME figures it out for you. So it's actually quite nice.
Fair enough. Now, the other couple questions I have market related before I pivot us to a couple other things.
Sure.
When we're coming into the tail end of the year here, and you see the market hovering where it is, you share your general thoughts and opinions all day. So I'm not looking to, recapture those. But more specifically, I am actually very curious how you are thinking about deploying your own portfolio in the current market environment. Year end is kind of arbitrary just because it's a date, but specifically during where we are now in the market cycle.
I am very underinvested right now. I do
Curious.
not, I do not, I do not like the risk reward at the current, levels of the indices. I know how dangerous it is to be in cash, and I know how dangerous, people think that to be on the sidelines when you could be missing out on, the greatest bull market, the end of the greatest, whatever, you know. Some people think it's got 5 or 10 more years to go. Some people think it's got 5 or 10 more minutes to go. I tend to be in the camp, I'm a risk reward trader. If I think that the markets have more risk to the downside than they have opportunity to the upside, I will move into mostly cash. And that's where I am right now. I just feel like, I keep tons of positions on. I probably have 70 or 80 different positions on right now. But most of those are option positions, and a lot of them are shorts and things like that. So, but my stock portfolio right now, very, very small.
Percentage wise, ballpark.
Percentage wise, 15.
Super light.
Super light. I'm usually way closer to 50, 60.
Yeah. So what would the trigger be to start utilizing more, not sitting at all-time highs?
Yeah. A pullback of 10 or 20%. Some
And
scare the children type move.
and then are you still doing, I imagine stuff like catalyst trades, earnings, stuff like that, that is its own bucket that is a little separate from like where the market's
I'm still a very active trader. So yeah, I trade everything. Today I probably traded, I don't know. I wasn't that active today, maybe 60 or 70 trades, but about half of them were futures and half of them were stocks.
and
Stock options.
is it intraday stuff or is it still that
Some of it
momentum
is,
style?
some of it is, but not really. I'm more of a, intermediate term trader. Like, let's call it, most of my positions are, into the 30s or 40 days. And most of my, I will trade some intraday stuff just for fun because I got to stay active. Otherwise I die. That's how, or you got to keep moving. Otherwise you die.
Fair enough.
But other than that, yeah, 30, 40 days, that kind of thing.
So everything is just sized down a lot, but the activity is still generally close to what you typically would.
My activity is down a little bit. My position size is down a little bit. My capital usage is down a little bit for the active stuff that I do. For the passive stuff I do, it's very down. So the active stuff's down a little bit. The passive stuff's down a lot.
Okay, understood. And for the passive stuff, can you talk a little bit more just about what the methodology is behind that?
The methodology for me on passive stuff is find something you like and don't overthink it. And you could like it for lots of different reasons. Some of it's just you like the company, you like the idea. Some of it is you like the price. I'm much more based on price. I'm a contrarian, so I will do things that other people hate just because other people hate it. So I'll buy something and I will sell something because everybody likes it. And, sometimes it works. It keeps me consistent. Sometimes it doesn't, but sometimes it works. But it keeps me consistent. I'm always taking the other side.
Fair. For your recent, a crowd-sourced question, people are asking how you're managing a trade that you had in Oracle.
I didn't do very well. I sold some premium at a little over 2 times the expected move in Oracle for earnings. and the actual move was 4 standard deviations, or 4 times the expected move. It turned out to be my worst trade of 2025. The way I managed it was that I spread it off on the opening, meaning, I reduced my deltas and risk on the opening. I got back about 30 to 35% of the loss, and that's it. I can't really make much else back for now. It's going to be a long slog. So I from my max loss, I'm down about 65% of my max loss, but it was still a horrible trade. Still my worst trade of 2025, the Oracle earnings trade. Yeah.
So talk, I didn't even know the details of it, but talk more then about the decision cycle. Like, you saw the move, and then talk to me about like actually what's going on in your brain when you see the move. I know it's not panic. I know it's okay, gonna have to do this, that. Yeah.
No, I mean, so I sold a bunch of calls at just over 2 times the expected move. The stock was trading at like I want to say 243, something like around 243, 245. That's where it closed.
Okay.
It opened, it had a $23 expected move. I had sold the 295s. So let's just say I was $50 above, over 2 times the expected move. Felt pretty good about it. Crappy premium, but something. I was selling calls for around $1 at 2 times the expected move. I kind of liked it. Stock opened at the expected move up $23 or $25. I'm thinking, okay, I'm pretty good here. And then it just started to take off. And then it was up, and then it was up. And then it rallied from, 270, which was around the expected move, all the way up to like 285, 290. I started to buy some stock at 285 and 290. I missed the rest of my stock I was trying to buy. And it went up to, opened about 315, went up to 345.
Super sorry to interject. I just want to get like a play-by-play as you're going. So you said you started buying stock.
After hours.
Okay, so what was the decision cycle to like buy stock? Did you have a price selected? We're like, I'm going to buy stock if it hits here?
No, but I didn't. At some point, there was a point where I was watching the stock after hours, and it didn't have a single downtick, and it looked like there was, a lot of stock on the bid to buy. So I figured, okay, I'm going to do something stupid here. I don't like to buy stock against an option position, especially my option position is still $10 out of the money. But I bought a little stock, and I wanted to buy more, but I'm like, I didn't want to get too deep into it in case it turned around. So I bought some stock, and then the rest of it was just, I had to wait till the opening the next day, and it was just a pure debacle.
When you say some stock, if you
I bought about 15 to 20% of my position.
Okay, so very little, just hedging a tiny little bit of it.
Yeah.
Okay. And then when you said
I would never hedge more than 50%.
Okay.
Because you just don't want to get like really double whammy. So 50% would have been my max anyway. And I got about 15%, I think. And that was maybe a little bit more than that. That's about it.
Okay. And you said that you wanted to get more. Why didn't you?
Oh, because when I had a bunch of limit orders in, because you have to use limit orders in after hours. And so I had like 285, 288, 290, and then I put more in at 287, and the stock never had another downtick. It went straight to 305.
I see. Got it.
I just missed it.
Yep, sure.
When it reached my short strike at 295, I didn't put any orders in.
Okay, got it. And again, sorry for the interruption. So now take us, market opens, you have your 15, 20% equity against your short calls. What's next?
Well, we opened, the next day at like 315, 320. The first thing I did was roll my short puts up from 200 to 315 because my puts were $50 below. They were worthless. So I rolled them up to 315s, and then the stock, what?
Same expiry?
Oh yeah, it was 0 day at that point. The 0 days or the 1 day. I can't remember if it was zero. It was probably 1 day. And then the stock started to run. So I rolled the puts up to 340. Again, that basically neutralized, not really, but kind of neutralized me. At the end of the day, the stock sold off to like, back down to like 310 or 315, something like that. And at that point, I didn't want to lose to the downside, because now I was totally, you know, I butchered it. I mean, I
You were
did the
in.
best I could do, but it was kind of butchering it. And then
Sure.
I just kind of closed out the position and sold some premium for the next day, and that was it. And stocks hung around ever since. And so I lost a lot of money and made back about 30% or 35% off my worst print.
And you said that you essentially flattened out the option position, the earnings play, and then you had sold some premium for the next day. Why the next day? Why'd you select that?
I was just mad.
Okay,
You
fair
know,
enough.
it was sometimes when you have a losing trade like that, I didn't want to give up. Like, it was still implied volatility at that point was still trading. The IV rank was over 100. You know, it was insane how much vol was in some of these options. So I didn't, you know, I just kind of recentered the strikes and reloaded a little bit. Reddit's not, I mean, I'm sorry, Oracle's not the greatest stock in the world to trade. So I was kind of, you know, I was done with it at that point,
Got
but
it.
I hung in for a couple extra days.
Sure, that all makes sense. And for anybody listening, I think a lot of people that reached out to me about that question, you can kind of tell that they were curious, like how you were like dealing with the pain, and it was like
Oh, the pain, though. So the pain I'm immune to because
right.
I've been doing this for so long, you know, like, um, it was like one of those days where, like, okay, it's a bad day, could be the worst day of the year, but it's not even in the top, you know, 20 in my career, the worst days. So, you know, I just deal with it and move on to the next one.
And
And
I
I'm
imagine.
pissed. I'm not happy about it, you know. Like, I'm pissed. I do not like to lose, and I don't like to get run over. And it happens, you know, once. Last time I got run over on an earnings trade was Zoom in like 2000 and, you know,
That got a
19.
lot of people. That got a lot of
I
people.
know. Zoom
Yeah.
got me that one year when it was trading for 360 and it opened at
Yep.
540. You
Yep.
know, I got caught on that freaking Zoom move. And so that move was twice as bad as this Oracle move. And that
And
was like, but that's the last time. So it's 2019, I think. So
yeah, you got to get a couple standard deviations once in a while.
yeah,
And
you got to get slapped. It's just the nature of trading is you get cocky, you get slapped, and then you go back and you know, you I don't know, you just regroup. You lie in the fetal position for a little bit, and then you just come back out and you pop out when you're ready, and you regroup. I've been doing that for, you know, 4 decades.
and I imagine another part of this that don't know if it's implicit for most other people, but the way that you're probably sizing your earnings plays is such that they're earnings plays.
Yeah, I usually size them pretty small, but for some ridiculous reason, I traded too big in Zoom and I traded too big in Oracle. But most of the time, I'm really good. Like, I'm really good about, you know, um, I'm really good about not trading too big. I don't know why those two. Whenever you get out of line, you lose your discipline. It freaking comes back to haunt you. You know, it's like the motherfucking option gods know, and they come out and they get you, and there's nothing you can do.
It's so funny because the largest percent drawdown I had on my portfolio was a super wide iron condor in the rut. And I had been trading them at a certain size and it had been so mellow. And
Yeah,
for this one trade, I literally was like, oh, I could size it up. And the exact yes.
yeah,
Yes to that.
they know. I mean, it's the same thing
Basically.
in Vegas. You know, you're just sitting at a table, you're playing, you're having fun, you're winning some hands, and as soon as you just, you know, all right, you know, as soon as you just push your pile in and you just step up your bets, that's when, you know, you have to double down, you have to split your cards, you know, you have to triple your bet, and that's where it kills you.
Definitely. And so I actually want to follow that thread because for bigger accounts, more seasoned traders, moves like that are manageable, right? It sucks, but it's manageable.
I mean, it doesn't matter. I mean, yeah, it's not going to put you out of business, that's for
Right.
sure.
And this is
But
that's more the thread that I wanted to pull on because for a
yeah,
smaller account, I think that emphasizes how important it is for them to actually maintain the discipline and sizing. They don't have the luxury
size is the only
of
thing you can do. There's nothing else other than size. I mean, the only thing that you have a small account, if you're going to play an earnings play, there is no way to defend it other than size. It's not defensive. I mean, there's no, you're going to have an incredibly high probability of profit. I mean, we were on a nice earnings roll. Now I had about a whole 2 earnings cycles going, we didn't barely had a loss. So you get a little cocky.
Now, I know that you don't have this broken out from like customer data and stuff like that, but if you were to ballpark the just community in general and your customers in general, what do you think the percentage is of them that trade earnings?
I would say of the active traders, 15 to 20%.
Got it. Okay. So a smaller subset. And then what percentage of your customers would you consider like active versus more passive?
Well, at Tasty, we are an active trading firm.
Right.
Nobody, passive investors will go to Schwab, Fidelity. They'll go to places where they have the services and, and products and things like that for more of a passive. There's a reason Schwab has, a couple $1 trillion in assets. There's a reason,
Sure.
Fidelity has the same thing. But Tasty is a firm for active traders. There's a reason we have better, faster technology. We support all strategies. We support, all the things that they don't for active traders. So for us, we're almost 90% active traders, whereas other firms might be, 12, 15%, 8%.
Matt, yeah. And then I imagine the performance of your clients, probably standard bell curve, right? I'm imagining you'll have some at both tails. Yeah.
Standard bell curve, 16% don't make it. And
Sure.
16% will outperform, the risk-free rates by some, crazy multiple. So we have both ends of the spectrum. That's our job, is to provide. We are not in a business to say we are going to be we are not there to have everybody having results that are tied to, some benchmark. We are there. And one of the things I say when I'm doing live shows is I've probably taken down, in the sense that, I probably cost more people money than from a trading perspective than anybody in this industry over the last 25 years. And the other side to that is I have probably helped to create more millionaires than anybody else in this industry for the last 25 years. That's both sides of that curve. And I feel good about that, because, I don't make or lose anybody any money. I just give you the technology and the mechanics, optimized mechanics, and the content to put yourself in a position to do something that no other firm does. But I can't control the 16% that are not going to make it and the 16% that are. Everybody else falls somewhere in that bell curve. And so when you think about it, about 50% are on the positive side of that 50 line, and about 50% are not. It works out. It's pretty damn, straightforward. And I think that's the challenge that every retail investor has. Listen, if you want to buy an index fund and not do anything, then go buy an index fund. Okay. But you don't need me. But if you want to, if you want to challenge yourself to be in that top 16% or that top 50%, then yeah, we'll give you all the tools.
Which, I don't know if you know this, but it's a perfect preamble into my next question, which is, you've made a bunch of different platforms, right? You've worked with probably millions of traders.
Yeah, I've worked with millions of traders. That's fair.
You've obviously seen a lot of the things that they lack, that they build over time. What are some of the things that you find behaviorally that you still, after all this time, still struggle to find ways to drive home for the broader population? Because obviously you have optimized mechanics, platforms. I imagine there's still some pieces from a behavioral element, at least, that are tough to crack. I want to know about those.
Well, I mean, there's a lot of bad history in the world of finance, meaning there's a lot of big firms that are financial service firms that are conflicted, that, that send the wrong message, that paint the wrong picture, that tell you that, you basically can't be successful. We are the ones, we know everything, you're at a disadvantage, blah, blah, blah. There's that issue. There's also a lot of snake oil salesmen that have no idea what they're doing. There's a lot of people that think they know what they're doing that have absolutely no idea what they're doing. So there's a lot of, there's a lot of shit you got to weed through on your way to get to, a certain spot. And it's very hard to find a firm like Tasty right out of the chute, or a firm like that we built at Thinkorswim. Those are hard. They never existed. We built the first few of those firms. So that's one challenge. Then there's all the, personal challenges of sorting through all that stuff. And also, just kind of human nature stuff. Like, it's hard to be really disciplined. I go to a perfect example is, I'll go out with my buddies. A couple of weeks ago, we went out and we went out to a local casino because a bunch of my friends, they're like poker freaks. I'm not, and they love playing poker. So we went to a local casino and they have a huge poker room. We're sitting there for, 3 hours into this poker thing. And I don't really care, like they're into it. They're serious about it. I could care less. And 3 hours into it, I'm like, I got to get the hell out of here. Like, this is, I don't even want to be here. I didn't care. I was up money at the time. And I'm like, I just, on the stupidest, the least disciplined play I made all night, I basically, pushed all my money in, go all in on a stupid bet, not even, no pot odds in my favor, not something I never would do, just because I wanted to get out of there. Like, I lost my discipline. Those guys, my buddies, would never lose their discipline because they play all the time. It's important to them. Like, they like, couldn't care less. I was done. I wanted to go home. I'm tired. I'd been a 15-hour day. I was just done there. I didn't want to be at that stupid, depressing poker table. So there are, so I will lose my discipline in something like that. I've lost my discipline in Vegas before, I've lost my discipline on a sports betting app because I don't really care. So I think that, but in the stock market, I care. And in the world of finance, I actually care. So I think a little bit depends, on how committed you are. I think a little bit it's human nature. Sometimes it's know-how. Sometimes it's discipline. Sometimes it's just passion and commitment. That's all.
I have another question on that. One of the things that I think most people struggle with is delayed gratification versus instant gratification.
Sure.
And something with respect to trading, I think that I've not been able to sort out in conversations with people is trying to encourage the delayed gratification embracing component, right? Because the probability of somebody making tons of money in their first few years of trading is low. Could it happen? Sure. But the probability is not super great. But if somebody's able to maintain a decent performance for a moderate amount of time, that can make literally life-changing money.
Yeah.
Have you found a way to broach that?
Yes. Well, I found the best way I have to broach that. Obviously, that's something we don't control. The instant gratification is something that, somebody makes money on their first trade, they think they're a genius, and then they're inevitably out of business very shortly thereafter. But here's how I have approached that. And this is kind of the whole Tasty. This is the foundation. This is our methodology and kind of the foundation of what we built. We realized early that there's a lot of limitations to what we can do with technology and what we can do with content. So what we decided to do was to build a platform that was geared towards high probability trades, not because we believed that just by doing a high probability trade, you're going to make money on balance, because that's ridiculous. Nobody in the world has ever figured that out. The statistical chance, if you have, 3 winners and 1 loser, and you have a 75% probability of success, if you play it out just straight on a numbers graph, it's just going to be a zero-sum game, because you're the 25%, you're going to lose 75% of the dollars, and it's going to zero out. But what I wanted to do was to take that thing where it said, I want you, if you have 4 rolls of the dice, every time you do it, I want you to win 3 times. and lose once. So because everybody else that talks about finance and teaches everything about entrepreneurship and everything else, you basically you're given 4 dice and you are told that, however you want to play this, let me know. And 99% of the people will choose, I'll take my 1 out of 4 chance to make big, instant gratification, just like you said. That's what people like. I'll take a 25% chance, to make a big hit. We decided to go the opposite way. We said, we want you to be right 75% of the time and learn how to win. Because learning how to win is way more valuable than learning how to take a stupid shot. And so even though the numbers play out the same, if you have a 1 in 4 chance to make something big and it hits every, law of large numbers, it hits over time, you're going to have the same exact ending P&L as the person that wins 3 times and loses once. But what I thought was so interesting about that is most people don't learn how to win. And by teaching people to win consistently, you teach them A, law of large numbers. B, you teach them discipline. C, you teach them optimization so that they can optimize the mechanics to give them a small amount of edge. And and D, you create a completely different level of risk-taking, decision-making, probabilistic analysis in your head. You do all this stuff that you can't do. Your whole speed of making decisions has changed. So by teaching people to win, I'm actually changing the world of investing. And that's always been our philosophy from day one. Whereas everybody else is like, listen, if you win one, it's the private equity mentality. All I need to do is win 2 out of 10. That doesn't work for individual investors. I mean, in a bull market, it works because everybody's a freaking genius. But in a bear market, it doesn't work. Or any kind of other market, it doesn't work.
One more question before we get you out of here. I know that you have to run. If the option gods played I would find it hilarious, to be honest. You would probably find it miserable. But if the option gods played the joke that you could no longer sell any option ever, how are you trading?
Well, I mean, I will, you play with the cards that you're allowed to play. I mean, okay. I trade digital currencies, for example. I trade Bitcoin, ETH, a couple of other, there's no options. I mean, it sucks. It's passive money. It's what I hate about digital assets, cash markets. It's what I hate about spot FX. I like the leverage in spot FX. I like the technology in digital currencies, but they're crappy, brain dead, black and white underlines. I mean, you do what you can do. Half the world has. Imagine if you live in the UK, they don't even have they don't have a derivatives market. Imagine if you live anywhere else in the world, there is no derivatives marketplace. You're kind of trapped by these, crappy black, white, simple, dead money assets. We're lucky in that we don't have that. But if that's all we had, then that's all I trade. I mean, I don't think you're ever going to see that because the world's moved in a completely different direction. I mean, now you can, with horrible odds, you can close out a football bet that you make after, 30 seconds.
So you wouldn't buy options? Is that the...
No. If that was my only choice was to buy options, then I'd buy options.
What approach would you take?
Well, I mean, are you saying you couldn't do strategy either? There's no spreads or anything?
Yeah, I would say no spreads.
Okay, so if it's just a straight option market where all you can do is buy them, then you just do it based on delta. That's it. So I would probably be wrapped somewhere around the 50 delta, and that would be it. So I'd be kind of at the money and playing the at the money game. And that would be all I would do. I mean, I don't buy out of the money crap. So I'd probably just buy at the money stuff and just play the game. But
what duration?
The duration for me would be, in most cases, the duration would be plus 30 days. I got to give myself some time to be right. The 0 day is too hard. So I need to have a little time to be right. So I like to buy duration, not leaps or any of that kind of stuff, but 30, 40 days in that range.
Beautiful. Last question. What is something that you're keeping your eye on into the end of the year, and why?
Something I'm keeping my eye on to the end of the year. Oh, I mean, a lot of things. Um, bonds, dollar. My biggest trade right now is just short the indices, S&Ps and NASDAQ. That's my biggest position right now because I think we're very overbought.
I love it. Tom, always awesome to hang out. For anybody that wants to get in touch with you, all the links will be in the notes below. We got you out of here on time. As promised, we always meet on time hacks.
I appreciate that. And I love our talks. We can do it anytime you want. I'm always available for you.
Thank you so much. We will see you all next time.